Whether you're a first-time investor or a seasoned investor, I'm sure you have a lot of questions pertaining to what's involved in getting a mortgage for that investment property. And in today's podcast, we're going to be talking with Nick Tavernese from Dominion Lending Centers. Nick has over 33 years experience in the mortgage field, and he's here to answer all the questions that you have so that you can become a savvy investor. Good morning, Nick. Thanks for joining us.
Hello, how are you? Thanks for having me back, Evelyn. It's good to be here.
Oh, thanks so much for coming. It's always great to talk to you. You always have so much great information and we learn a lot. I know I have a lot of clients, and I'm sure that there's a lot of people out there who are looking to invest in properties, and there's all different types of investments that they can do. And obviously, one of the first places they need to start is with the financing. How much money are they able to secure? And that will help them determine what kind of investment property they can actually get. So maybe we can start with how a lender defines an investor.
Well, an investor property would be a property where the actual owner does not live in. So it's a non-owner occupied property, would be an investment property. That's basically very simple. Yeah.
Okay. So if there's a property and say somebody wants to buy a house and there's a basement apartment in it and they're going to rent out the basement apartment, that's not considered an investment property.
No, that's still, well, there could be rental income investment, yes. But the way the banks and lenders would look at it is because the owner is living in one of the units, then it's still owner occupied.
Okay, great. And so if someone is looking to buy an investment property, what are the basic things that the bank or the lender is going to look at?
Like in the regular purchase side of a traditional or a primary residence, in the investment side, we still look at the income, we still look at the down payment, and the credit's got to be it's got to be stellar as well. When we look at the down payment, different lenders have different cutoff points for what down payment they would look at. Some lenders will look at minimum of 25% down of the purchase price, and some of the other lenders would accept 20% down. So we have different lenders. And depending on the situation, we could, navigate to those different lenders to see what best fits the purchaser. So hopefully answered that question for you.
Yeah, that did. So in terms of down payments, there's some variables. The other two major things that lenders are looking at is income and your credit score. So can you speak to that?
So with the beauty of buying an investment property is the fact that we can use that rental income or part of that rental income. Some lenders we use 80%, some less, maybe more. But the fact is that we can use more income than just the income that the applicants, are from their employment income. We can use the rental income as well to help qualify. Where I found big impact is for young people that are buying investment properties that are still living at home. Those applicants are so much further ahead and for qualifying because they don't have another mortgage that we have to take into account into their ratio. They're living at home paying no rent most times. So that's a tremendous plus when you're applying and getting approved for the investment property. But income and the rental income added to their base income is a big help.
That's actually a golden nugget that you just shared with us, Nick, because there are so many young people and some not so young, but who haven't delved into the real estate market. And they're like, I'm finding it so hard to get into the market. But you're absolutely right. If they're still living at home or where they're not paying rent or they're in a very low rental basement apartment or something where they're not paying very much, then I guess the banks would look at their full income plus part of that rental income, and it would allow them to qualify for the
other expenses. I'll share a personal experience. One of my friends, we're about the same age. We both got married. He got married and spent $30,000 to fix up his parents' basement. And he lived in that basement. And where I went on and bought a house, got fully mortgaged, big mortgage. but he spent $30,000 and fixed their basement, his parents' basement. He lived there for 7 years. His wife wasn't too happy, but in that 7 years, he bought, I think, 3 rental properties. And after he bought those rental properties, then he bought his primary residence. And he's so much further ahead than I am today. It's incredible. So if you can, maybe, he sacrificed and his wife sacrificed, but the potential for I just get excited. The potential, if you could do it while you're young, buy something, stay with family and get in the market. Yeah, you're not living in it, but you're building equity. It's just huge.
I think that is such a golden nugget for investors, or even investors who've got young kids, or just first-time buyers that are listening to this podcast. That is really great advice. Now, do the lenders look at property differently? So first of all, let's talk about the property itself. What are they looking for in terms of how many rental units a property would have within the investment property?
So to be considered under the residential side, under the residential umbrella, most lenders will go up to, if you're buying a property, can't have more than 4 units. So 4 rental units is the max to be under the residential portfolio or the residential side. Yeah. So I hope, was there something else that you were looking at? Yeah. So unit wise, it's up to 4. Anything over that, we can still look at it, but it would go to our commercial partners.
Okay, great. Now, what about the way that the lenders qualify a property if it's a freehold property, and if it's a condo property and there's maintenance fees attached to that purchase? Is the qualifications differ, or do they look at it exactly the same?
Well, no, the condo fees have to be taken into account as well as the property taxes. But yeah, no, we would, there's no difference on how we qualify if it's a condo or a freehold property. Just in the condo side of things, there's going to be that monthly fee.
So that fee is tied into when they're doing the calculations of how much money they are qualified to lend out.
Exactly. Okay. Yes.
Now, we're also hearing a lot about monoline lenders versus B-line lenders. Can you?
Well, a monoline lender is just the difference between them and a B lender. Monolines are basic lenders that just do mortgages and are only accessible through people or through brokerages like ourselves. The general public will not have access to them. They have great rates. If we can get your application in front of them, they have great rates. But the difference between them and the B lenders is that they're not accessible to the general public. Like a mono lender would be First National, Street Capital would be one of the few of the mono lenders out there, but they have great rates if we can get the applicant's application approved through them. B lenders are more, we have a difficult deal that doesn't fit the mainstream or the monoline lenders. Like a home trust will do first and seconds that have people that are applicants that have bruised credit, maybe don't have the income to satisfy the traditional route.
Okay. So the advantage of working with a mortgage broker, such as yourself, is that you're able to take your client and look at a variety of different lenders and match the client to the lender. Is that correct?
Yes, that's correct. So we have about 120 lenders that we could work with. But yeah, so we have a variety of products, and we have that access to those monoline lenders that the public won't have access to. So it's kind of nice, and we can provide, because we have that range of products, we provide that better advice piece to what we feel that the applicants should be looking for.
Right. And so that's definitely an advantage for the applicant, because they do have choice. But in terms of fees, if they use a mortgage broker, a lot of people are under the assumption, if I go to my traditional bank, it's going to be free. If I go to a mortgage broker, now I'm going to have to pay a fee. Is that true?
Not necessarily, because as a broker, we have access to Bank of Nova Scotia, we have access to TD, HSBC. So we have a lot of those primary banks available to us as well. If we're going to those primary banks, normally they pay the brokerage a fee or a lender fee or a referral fee. So we don't have to charge our clients. The only time where we would have to look at fees is if we're going to a B lender, we're looking at an applicant that has bruised credit, has issues with income, does not qualify under the traditional routes, then yes, then if we can't get that application looked at the Schedule A banks or the monoline lenders, we might have to go to our B side. And that's where, yeah, there's gonna be lender fees and higher rates. Unfortunately, then it depends how badly the applicants want to get this property. So there is a space, and these B lenders, they don't want their applicants there for the rest of their lives, or normally we'll do a 1-year term. And then after that term is up, we can reevaluate, the applicant situation and see if we can bring them back into the A world, right, into the mainstream bank.
Right. And so that sort of brings up another topic that a lot of purchasers have. The first question they always ask me is, well, what's the rate? What's the rate? I always say to them, it's not just about the rate. It's like anything in life. It's not just about the price. Yeah. It's about the service. It's about the options. And so I'm thinking, and maybe you can correct me, that if you're looking at a mortgage product, you want obviously a good competitive rate, but you want a mortgage that has a versatility. So it depends on your individual situation. Are you planning to have this a long term? Are you planning to be a short term? Are you expecting a big chunk of money from something, an investment that you're going to cash out, or an inheritance, or something that you want to put a big chunk of money down, and maybe you want a mortgage that has the ability to have prepayment privileges? Or maybe you're thinking, I want this investment for a year or two, and then I want to move to a different investment. So can you maybe speak to what other things other than rate is important?
Rates, I'm not going to lie, it is important, but like you said, it's not the only thing. There is things like what options are available in that mortgage. What I've found in the past is that the institution or the lender that's offering that lowest rate in the market maybe doesn't have the prepayment options. You're not going to be able to port that mortgage. What you got to really take a look at, do a deep dive and into that lender's product offering to see if it's competitive with with the mainstream or somebody that doesn't have that much of a attractive rate. So being in the business for so many years, I haven't lost too many deals because of rate, because we're able to give advice and just bring the clients, make aware of the options that we had on our product over the years. So rate's not the end all.
Mm-hmm. Okay. How do the lenders look at the income when it's coming from a rental property? Do they consider 100% of the income that it gets? Do they consider a portion of the income? And second part to that question is, do they need to have a lease in place at the time of them getting this mortgage?
Okay. So in my past experience, if you're looking at a purchase, then the lenders, some of them will need a lease, but if it's a purchase, how are you going to get a lease for somebody? And we need to use that rental income in our application. So what ends up happening that we would do a market rent when we order the appraisal at the same time. So in that case, it's a new property to the owner. We wouldn't need a lease. It's just our appraiser would give us a market opinion of the rents. As far as what the lenders would use, the value of that market opinion, probably some of them would use 80%, some 75% of those market rents. I would say very rarely would they use 100% if it's just a market rent. But if you have an applicant that's looking to refinance a rental property, and he's had that rental property for a few years and with confirmed rents, then yes, we would need to see a lease, income tax returns to see that that income is being claimed for taxes. Then once that rental is confirmed, then the lenders would most likely use 100% of the rents to be added to the applicant's income.
Okay. And how many properties can a single investor buy? So maybe there's an investor, they've got their principal residence, maybe they have one investment property, and now they're looking to build out their portfolio. Yeah. What is the maximum, or is there even a maximum as to how many properties an investor can have?
So different lenders, so there are going to be different lenders that have different requirements. I've seen up to 5 rental for other non-rental properties. So 9 total, but it depends on the lender. Was there a second part to that question? Sorry.
How many could they buy? And
I think that was it. Evelyn.
So just going back to what you said, they can have up to 5 rental properties,
yes,
plus their principal residence,
yeah,
and 4 other properties. What would those 4 other properties?
So maybe for their kids, that they're all other properties that are non-rental. So maybe an investment property, maybe a cottage, maybe a property for their kids, so that they're on title, but that it's non-investment. But different lenders, we would have to look at seeing what they're offering. But I've seen up to 5 rentals. But you have to make sure when you're getting these rentals that you have to actually qualify to carry all these rentals.
Mm-hmm. And that leads me to another question. So someone qualifies for the rental property, everything is good. But I always say to them, you want to have a little bit of money in reserve. You don't want to go to your max because, first of all, it might take a little bit of time to find that right tenant, and there may be a lapse between tenants. So they should have some money in reserve. Is there a rule of thumb as to how much money they should have?
I would say that they should have at least 6 months of rents in the bank account. So when they're looking at buying, they should always have the down payment accumulated, closing costs, plus about 6 months, just in case you get a little disconnected with the tenants not, either not finding the property or maybe somebody's not making a payment. So about 6 months. And some of the lenders will ask to see that they have those funds available. Not that they will tag it or in any way that they will restrict their savings, but we want to see that they have access to at least 6 months.
Okay. And that access could be in the form of a line of credit or something. It doesn't have to be cash.
Yes, line of credit or preferably savings. But if they can tap into a line of credit if they have to. But we prefer to see it in accumulated savings.
Okay. So what if an individual does not have 6 months of savings?
And if that's a pre-requirement or a prerequisite for the lender, that could be an issue. That could be a showstopper.
So are all lenders requiring that?
The ones that I've dealt with in the past have, yeah. Okay. But again, there's 120 lenders. So, I could come back to you and clarify with that. But from what I've seen, most lenders want to see that little comfort zone.
Okay. All right. And do lenders look at a property differently? If someone is buying a house and there's the main part of the house and then there's a basement apartment and they're going to use both units as rental income, do they take 80% or up to 80% of both of those units? Or is it 80% of one and less of the other? How do they look at that type of property?
So if it's a purchase, and the properties has 2 units, what we would do is indicate to our appraisal to give us an idea of both the units, what their marketability is. And then depending on the lender, we'll take 80% or 75% of the values of those rents.
Okay. For these investment properties, is there a maximum ceiling that they're looking at? In terms of funds, like is it $1 million or less, or can they go over $1 million?
No, you could. I've seen them go over $1 million. It's just depending where some of the lenders have restrictions because they where the property is located. So they might cut back on or they might say that you need more down payment if you're buying in the outskirts, or they might say, if you're buying in the outskirts, that's not a very marketable area for rents. So they were going to disqualify that property for being a rental. Or the lender say, well, because it's not in, it's not an hour away from the GTA or major metropolitan center, we're only going to go, 65% loan to value or 70% loan to value.
Okay. And talking about location of where the property is, you said if it's outskirts, they're looking like there's not going to be as many people who are looking for a rental in the outskirts. What about if it's in an area that is more like a recreation area? So maybe there's skiing in the winter time and there's boating in the summer.
That's a good question. So if it's a property like that has, a vacation kind of element to it, like an Airbnb, or if it's a unit, a condo that's part of a hotel complex, that some of the lenders sort of would shy away that, because that if we ever have to take that property back, God forbid, the marketability of that property, you're reducing the number of people that actually would want to buy that kind of type of property, right? So if it's tied to a hotel or part of an Airbnb kind of thing, that might not be looked at too favorably with some of our lenders.
Okay, so if you're looking to buy a property strictly as Airbnb, then that might not be something
that might be, because it's a business. It might be zone commercial, or like a commercial kind of application.
Okay, so that's different, totally different from buying an investment property and just renting it out, leasing it out long term. Okay, and is there any requirement as to how long the initial lease is?
Not that I've seen. No, not that I've seen it. We just want to see like if it's an existing property, we want to see a history of at least 3 months. If it's a new property or fairly new that they haven't filed taxes for the last tax season, we want to see a lease and 3 months history of rents. That's what we're looking at least.
And what about an individual who's looking to buy a property and they're going to rent it out to a family member, whether it's one of their kids or, a cousin or something like that? Is that looked at any different?
That's still a rental property because it's non-owner occupied. But, they might give that family member a break on the rents. But again, we're not using the rents because it's a purchase and we have no history of rental for that particular property. So what we're going to be relying on there is that market rent. So we'll use the market rent, and it's up to the individual owner to charge whatever they feel is fair to that family member.
And they'll have to make up any shortfall if there is, obviously, right?
Yeah.
Okay.
Family cost.
Right. So if you were to give advice as to what things, maybe 3 things or 4 things that an investor should have before they even think about investing, what would you get?
Like I said right at the beginning, Evelyn, don't wait. Start while you're young. And I think keep your credit clean, but get into that rental market even before, if you can, even before you buy your primary residence. So, and just, save to get that down payment, keep the credit clean. And that's basically it.
Okay. And just to recap on what exactly are the minimum requirements of most institutions for lending?
For credit, like a score, we would look at I would say around 650 Beacon score, no less. And as far as what are the requirements is the down payment and the income.
Okay, excellent. Well, that's great advice. Thank you so much again for sharing your time with us, Nick. And if anybody would like to reach out to you with questions, how can they do that?
They can simply email me at approvalsbynick@gmail.com or on my cell at 416-573-2641.
Great. Thank you again. And hopefully we'll have you on for some additional conversations. It was very enlightening.
Thank you. Thank you, Evelyn. It's been fun being here. Take care. Bye-bye.